So the tariff tumult that is supposed to kick off on April 2nd has prompted some unusual activity in precious metals. We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mike. So the interesting thing that has been going on lately is related to, and I've alluded to this on prior live streams, the fact that there is a lot of physical delivery going on in precious metals on the COMEX. What is also coming to my attention is that concerns about tariffs, so there are different rules that will apply with respect to tariffs if precious metals are being moved from one place to another based on whether or not it is viewed as monetary or if it is for, say, industrial use. My understanding is that this is causing an acceleration in some deliveries of silver from London to the United States. Now, one of the things I would just quickly point out is that in commodities that can have real supply-demand imbalances in the short term, so what kind of commodities would we be referring to there? That would be things like electricity. Potentially it could be something like natural gas. The precious metals don't usually qualify. And you can usually also observe this by taking a look, for example, at the futures curve. So let me see if I can pull that up. Did I get this right? I must have typed the wrong symbol in here. Here we are. So this is the active contract. And this is what you would normally expect to see. So when the spot market and the nearer dated futures trade at a discount to the longer dated futures, we refer to that market as being in contango. If it was reversed, such that the near dated, whether the spot market, so the actual physical, or the near dated futures are trading over the long dated, then we say that that market is in backwardation. Now, the normal course of it would be that the longer dated futures for a precious metal would trade as a premium, as you would see here. And there's a couple of reasons for this, but we don't have to get too into it because it isn't really going to be a talk about carry cost. But as you can imagine, if you have a future that, the holder of which will take delivery of the underlying commodity at some point in the future, that should trade at a premium to the current spot price of the metal, because you don't have to tie up the capital, and you don't have to store, and you don't have to insure it. So we call that carry cost. There can be others, but the longer dated futures will essentially account for these carry costs. So the interesting thing to me is that if there is going to be some acceleration, or if we have circumstances that are going to create even additional demand for precious metals, then I would be inclined to be bullish. Now, I wanted to make just one quick point here, which is, and I thought this would probably be helpful, and that is that I'm going to just do, see if we can get this in here. I was inclined to put on a bullish silver position today. I was probably going to do it with the futures. I've decided to hold off on that temporarily, just because this is one of those situations where I think these things can behave much more reliably on the technicals. And this, the commodity channel index just happens to be the best performing of these over the course of the last couple of years. So I think we're kind of right in the middle of the channel. So I'm sort of in this do nothing phase, if you will. But I am inclined to be prepared to go long here if it dips. And you can see that actually, as a technical indicator, this has been quite effective over the course of the last year. So this makes an assumption that you're trading the way Bloomberg defaults. It's $100 million in capital. So the P&L here over the course of the last 12 months is about 64%. If you adhered to this regime, not terribly long in terms of the average trade duration. I do think that one could be long in any case. So different ways that you can potentially play this. And I'm getting a lot of chimes in my ears. I'm not sure why. It could be one of my trading applications is giving me a bunch of alerts. I'm going to just kill that just in case. It's causing my system to choke. Okay, so if you're inclined to play silver on the long side with the futures, I think we're close. We're not quite there yet. I'm probably guessing we're going to get to the bottom end of this range within the next week or so. At which point I'd think going long futures would be a fine approach. However, if that is not your inclination, and I recognize that not everybody trades futures, there are other ways that one can play this. And let me just pull up options play. So SLV is the ETF that tracks silver. So that would be one potential way to play it. Another way to potentially play it would be through the miners. And what's interesting is that the precious metal miners really have grossly underperformed the precious metals themselves over the last several years. And part of that stems from the fact that you can have a circumstance where you have rising inflation, you have rising precious metal prices, which is their output, that's what they sell. But of course, if you have substantially higher input costs in terms of energy, in terms of labor, and actually geopolitical risk too, I would point out, because oftentimes miners operate in places that don't necessarily always preserve the concept of private property, and you always are subject to potential risk associated with that. But let's just take a look at this. If we were going to use SLV first. And, we actually touched on this. Did we touch on this with Dennis Davitt last week? I think we may have. And that is, or maybe it was with Jim Urio, I'm not sure. But one of the things I just want to point out is that in some commodities, and you'll see this in Bitcoin for sure, sometimes you will see that the upside options trade at a premium to the downside options. So in other words, they exhibit call skew rather than put skew. And that is the case for silver. So what that does is it means that if you buy an at-the-money option, you're kind of paying the lowest implied volatility on the board. And so what I think one could seriously consider here is call spread risk reversals or calendar call spread risk reversals in SLV to kind of take advantage of that dynamic. So maybe you would, I'm just going to construct one here. And because this is going to be short two options, the way I'm going to lay it out, and long one, it's not really a long premium trade by design. So you don't have to worry too much about theta in theory. So we're going to just take a look, and we might pick up the 30s or the 30.5 calls, go like that, sell the downside puts here, and maybe we'll just do something like a 20 delta call and put. A little bit difficult here because, it's going to look a little something like this. Your mileage will vary depending on where things open up tomorrow. If this is the kind of thing you're looking at, I might actually just bring this in just a little bit, make it 33.5 like this. So 27.5, 30.5, 33.5. So basically you get $3 a side to where you'd be put versus where you get called away. 10% move. Looks a little something like this. So that's a way that you could potentially play it if you're more inclined to do a set and forget. Like I said, I think we're probably going to reach the bottom end of that commodity channel that I previously illustrated. So that's the reason I didn't actually put a trade on today in it. I was going to, and decided I was going to wait just a little bit. One other quick point. This is unrelated to this. In Lululemon, which many of you will know is one of my Holly Index names, and I figured I would just bring this up because they are going to be reporting earnings, and I wanted to point out some information that I was looking at. So, again, just to rehash it for anybody who hasn't watched previously, I have a couple rules of thumb generally that I kind of like to think about if I'm going to get long a stock. And that is that I like to pick stocks where, number one, I obviously understand their business, where usually based on somebody else's assessment, not mine, because I'm not much of a shopper. It's a well-loved product, serves an attractive demographic, and is growing the top and the bottom line as fast or faster than the broad market generally does, or is trading at a material discount to it. I also like to look at situations where you can take two companies within a group and identify one as being fairly clearly overpriced and the other as being, all else equal, fairly underpriced. So I had a 1x2. I talked about this on CNBC. I think I talked about it on the live stream. I know I wrote an article about it. I had a 1x2 put spread on in Nike going into earnings. Now, the one I talked about on CNBC was longer dated. The one I had on personally actually expired on Friday, and my long puts, those were in the money. So the trade, it was what did I have on? I was short the 67.5s, and I actually, intraday, the stock traded well below that, and I actually anticipated that I was going to end up being assigned. So I think it was the 70, 67.5, 1x2. I'd actually put it on for a credit. Would have gotten long around 65, and the stock traded down to that level. However, I was a little bit distracted on Friday by our other live stream and didn't realize that the stock had rebounded. I think it closed at 67.94. So my long puts were exercised, auto-exercised, because they were more than a penny in the money. Obviously, they were actually dollars in the money. But the 67.5s weren't. So I had actually expected to come in long a little bit of Nike at a much lower level, at a basis of about 65 or slightly under. And in fact, I came in short. I covered straight away on the open. So I was still profitable, not as profitable as I should have been. But Nike was a trade that I rather liked on the short side against Lulu long and against Deckers long. So those are two, more niche athletic apparel and shoe companies that we're seeing good growth. But this was what I wanted to show you. And maybe I can just blow this up just a little bit. Okay, so these are the get rid of that. These are the meaningful, actually this is the way this graphics are working, that doesn't really help you. This is the meaningful numbers that I thought sort of caught my eye. And that is, so these are two different alternative data sources, Placer AI and Bloomberg Second Measure. Placer AI, interesting business. They track tens of millions of cell phone users, and they can see where they're going. So, and they also can map that against a database of known retail outlets. So they can use that to estimate whether foot traffic into stores is rising or falling. So you'll notice over here that according to Placer AI's estimates, at least, based on this mobile tracking data, they actually saw year-on-year declines. Their estimate is for a year-on-year decline through the end of February in foot traffic. So from my perspective, that's a little bit alarming because, Lulu had been growing the top line at, we'll call it, mid-high 7s to 8% similar on the EPS growth side. And, the forecast right now through the end of the year is close to 10 and 7.2 for next year. I still think that was a very attractive level to buy in, because I actually expect top line growth for the S&P to probably fall a little bit below that number. So I just happened to have this number off the top of my head because I was looking at it very recently in the context of U.S. versus international markets. The U.S., the S&P 500 has grown EPS at a compound annual growth rate on average of about 8% over the last 10 years. So that's kind of my bogey. If you can see a number on the high side of that, I actually am expecting that number is probably going to come in a little bit lighter just based on uncertainty and things like this over the next 12 months. So I was thinking more like 6.5. So if I'm getting a 7.5 EPS growth and a 7% top line growth, which is what I had previously been expecting for Lulu, and I can get it at a cheaper multiple. So S&P was trading 23, 24 times, Lulu at 21. That made some sense. Lulu also has basically the key demo, so upper middle class and affluent consumers, healthy, relatively young demographic, the whole shebang. Then I saw this, and it got me a little bit concerned because, of course, if foot traffic is actually going down year on year, you could still see sales growth. I want to make it clear that just because foot traffic is going down, that doesn't mean that the number of transactions is going down, and it doesn't mean that the total amount of transactions is going down. But it's harder, right? So if you've got fewer people coming into the store, the ones that are coming, hopefully they are purchasing at least as robustly as they had been previously. So it was with this in mind that I sort of looked back on a trade recommendation that I had made in Lulu back on October 24th. So on October 24th, I had suggested a pairs trade that was long a 285, 330 call spread in Lulu. And as you can see, it actually went right to the high strike. And a long 85-70 put spread in Nike. Both of those trades expire this week as it happens. So this is the reason why I'm updating it now. So if you happen to follow that advice, then there's something to do. But I wanted to provide a more meaningful update on Lulu. So the Nike trade, look, it's made all the money it can make. 85-70 put spread is basically completely in the money. Stock's trading 67.5 here. Expires at the end of the week. There's very little more money that trade can make. You might as well just take the profits and run. Lululemon, actually, it's the same story, only it's more important at this point because the 285, 330 call spread is now $5 in the money, but they've got earnings coming up, and the stock's implying a 9% move. So if it goes 9% higher and you're long that call spread, you can't really get much more money out of it. You can get a little bit more money, and we can see where that call spread is trading right now. But you can give back a lot of the profits that you've already made because the stock was trading, I think, 265, 270-ish when I recommended this. So my thinking is to put on a 1x2 put spread here ahead of earnings, again, for very close to zero cost, that targets the price where we got long Lulu in the first place last October. Now, it's entirely possible. If some of you, read the articles I wrote back then, if you got long the stock, or even if you bought this call spread, there's a very good chance you actually already took it off. And the open interest suggested this. So one of the things I did was I took a look at the open interest, and the open interest was really pretty modest. And there's a reason why. I mean, if any of you guys are watching and you put the trade on, I can see why you would have taken it off. Why? Because the stock gunned very shortly after we made that recommendation, right? In fact, it was actually on its uptrend. So it was back on the 24th. You can see the stock was well off the lows. And it went from wherever it was at the time. I think it was, like I said, it was the 285 calls that I had recommended. So it was probably right around that level. Stock got up to $400 in the meantime. So the chances that anybody who had that call spread on hasn't already taken profits, because it was basically reached peak profitability earlier this year, actually even right before Christmas. But if some of you still have it on, no harm, no foul, right? I mean, you've been tying up your capital, but still you're going to make your max profits. But take it off now because there's no reason to wear this thing through earnings. So what would I suggest through earnings instead? I suggest a 1x2 put spread instead, because when I was looking at this yesterday, and I haven't put this on yet myself, but I'll probably do it tomorrow because they report on Thursday, so that's about how much time we have. My guess is that if that foot traffic number does in fact translate to results, I think that we're probably more likely to see the implied move to the downside. And I think it'll be actually pretty attractive at those, because bear this in mind, Nike's sales are going to be down something like 10% year on year. So they're not going to turn that ship around. And I actually also think that brand loyalty for Lulu is a different thing than Nike. People are buying these, and look, totally anecdotal. I ask people who buy this stuff, including my wife, why do you buy it? Are you changing, your attitude about it? And the answer is no. The people who buy these products buy it because they like the product. It's not because of the label or the style or anything like that, although they do like the style. She does say that she likes the style of Lulu better and she likes the quality of Vuori better. I don't know why. Vuori is a privately traded company, so we can't come up with a trade on that one, unfortunately. But so let's take a look here. So I think a 1x2 put spread going into earnings, probably, oops, yep. I'm changing the structure without changing the ticker first. Got to do that first. And actually, just one other quick point, because I think this is important too. A 1x2 is a net short options strategy, right? So if you're going to be net short options, give some thought, number one, to the fundamentals. Where are you willing to get long this thing? And secondly, the thing you really want to pay some attention to is whether or not you think, so we're going to go in here, the options prices are suitably elevated going into the print. And that's why I just wanted to bring this up really quickly if we can. So this is where we are right now, okay? So you can see that, yeah, was there a bigger implied move here? There was a couple quarters ago. So 2 quarters ago, 3 quarters ago. Basically the only time in the last 3 years that the implied move was greater than it is right now. So there's a pretty big implied move. And the stock has already come in quite a lot from its highs. It's trading 335-ish, down from 400 recently. So what does that get us? So I think the trade here, and you don't need to, when I'm looking at these 1x2s, I want to be pretty clear about something else. The first thing I try to take a look at is, if I'm going to be short 2 puts, where am I going to end up owning the stock? And as I previously pointed out, the level I was looking at was that price back around when I had originally recommended this trade on the long side back in October. So that's down around this level here, right? So we're looking at 265, 270-ish. So that's kind of the level at which I say, okay, I'm ready to start to buy some stock at that point. So I use that as kind of the beginning of how I'm going to structure this 1x2. So if I'm willing to get long at, call it 270, the stock's trading 330, 270, one way to think about that is, if I buy it at 300, but I made a $30 profit on the way, then that's going to be around that 270 level. So that's a trade that's going to look a little bit like this, right? So I get the 330 puts, I sell 2 of the 300s against it. It's pretty close to even money to put this trade on. I'm willing to pay a little bit of premium out. The reason I'm willing to do that is because the vol crush is actually a tailwind for me after the earnings come out. All right, so all else equal, if I can pay $1.60 and give myself a little bit more of a downside buffer versus saying, oh, you know what, I'll trade the 320. So if I trade the 320, 300, then, and we can actually, I don't need to even hypothesize about it. So let's just say what happens there. So that's going to be, then I'm going to collect about $2.77. Still get that vol crush, but the downside break even is coming in as I do that. So we can see that here. So the downside break even here is 277.5. Downside break even if I use the 300, the 330s, is going to be a bit lower, right? So about $6 lower, 1%. So you can play with this a little bit. Obviously, again, your mileage is going to vary a little bit based on wherever the stock opens up tomorrow. Options premiums are a little bit elevated. I don't mind getting the stock at a decent-sized discount to where it is right now. So 270 over, 335-ish. That's a 20% discount to the current stock price, right? So that's the reason. And I was actually going to be inclined to make a bullish play going into earnings until I saw, again, so what prompted me to take this more cautious approach and say, yeah, I'll get long the stock, but at a lower level. The short version is that it was this right here. It's really the placer data. By the way, Bloomberg's second measure data up 3.2%. That's good and way better than the industry. But you can see how much weakness the industry is under. So both of them are saying, both sources of alt data are saying Lulu's outperforming the group. But both are saying the group's in trouble. And this is something we know about. We've talked about it a lot. Consumers, their ability to spend is limited, and there seems to be some signs of consumer exhaustion. This would be a demographic that would be less affected than some others, but that's what we have. Okay, so I think between silver and between silver and Lulu, I think we're off to a good start. And with that, why don't we take a few questions? So Finwest, good morning and aloha. Happy Monday. Returning home to Bangkok tomorrow, so we'll catch your future broadcast at 3:15 a.m. Yikes. You're always worth keeping me awake. Well, they're still on YouTube. They're always recorded, so you can watch them. And then, you have the great pleasure of being able to do what I do. So I love to listen to podcasts. I love to listen to other people's YouTube stuff. There's a lot of great content out there. The problem is there's just not enough time. So I have gotten myself to a place where I'm listening to most of the stuff at about 1.25 times speed or 1.5 times speed. And sometimes what I'll do is I'll join something late and then run it fast and then just catch the tail end. If you want to ask some questions, it gets a little bit harder. But you could always, by the way, you guys can always put your questions into the comments section for these videos afterwards, and we do look at them. I can't say it's totally religious thing where I answer every one of them, but that's another way to get it, so you don't have to stay up until 3:15. All right, Alex asks, good day to you, Mike. You mentioned quite a few times about 30 delta put protection. At what delta do you think I should get out or roll? I have SPY June 560 puts. Yes. I'm not the only one who has said that, by the way. That used to be kind of the de facto recommendation that Goldman Sachs used to make, among others. It's a nice blend of convexity and, premium spent. So, one of the reasons that we like to be long options when we're long options is so that you get that curvature. You have a little bit less risk and you have, stuff like that. So, Tucker D. Dog. Unfortunately, many people talk slowly and their videos almost require speed up. However, I'm not sure I could keep up with this one at 1.5 times. Use 1.25. And you can always pause, right? If I talk too fast, you can always pause or slow down. But there are times when I slow down and say lots of ums, uhs, or whatever, or I'm putzing around trying to do one thing or another. So on your 30 delta puts, I do still like those. I definitely like them when you have a known catalyst and the premiums are relatively low. 60 delta is the number that I almost assuredly would probably be looking to roll or adjust on the long or the short side, just so you know. So let's just say bought a 30 delta put, underlying goes down. It's now through it, right? Gets to 60 delta. Maybe you adjust. Roll the 60s down to the 30s. You can press and roll. What do I mean by that? You can take all of the money and then take that and apply that to that lower one if you are pressing a directional position. Or alternatively, and I've seen many long equity managers that used options to hedge their portfolio do this, which is that when it gets to that higher delta, then they adjust and roll down to the original target delta of 30, and you are at that point taking some of your profits off the table. Okay? And so you can kind of have that target delta in mind. And then, by the way, if the market then rallies again and your 30 delta puts go, let's call it to 0 or some 10, then you can roll back up again and buy back maybe the original options that you had now at a lower price. So you're kind of trading your gamma a little bit there. But 60 delta is definitely an alarm bell to me. If you are short calls, for example, against a long stock position and they go to 60 delta, that means that the probability that those options expire in the money is now greater than not. Okay? If you own a 30 delta put as a hedge against your portfolio, the idea is that you monetize your hedges if and when you can, because otherwise there's almost no purpose to it, right? So if I buy a 30 delta put, it is decaying away, and the market rolls, goes down. Now it goes through that strike, and I just sit and do nothing. It's still decaying, right? Still decaying, it's still decaying. And then if the market comes back, well, all I did was spend premium and I never got anything for it because I never monetized that option. So I would say 60 delta, for me, is where I sort of set my alerts and set my triggers. Other people may do it a little bit more aggressively, but I think that's a good starting point. PC says, if the SPX skew is flat, it means the implied volatility is approximately the same over at the money and out of the money strikes, and the crowd is hedged on SPX. Wouldn't buying put spreads make sense? Okay. So yes, if there's no skew, then it's true, the implied volatility of the respective options, whatever underlying asset it is you're looking at, doesn't really matter, right? So I'm trying to think if there's an instrument that has a really flat skew that I could use as an example. I've spoken to plenty of people who joined the industry before I did, before the crash in 1987, and things didn't trade with skew, believe it or not. Everything was just flat implied volatility. So they just had a volatility assumption and they plugged it in for every option. That was clearly a mistake, as people learned on the crash in Black Monday in October of 1987. SPX shouldn't trade with flat skew, though. It should almost always have put skew, and it almost always does. I'm trying to remember. Yeah, I mean, it's going to have negative skew. So we'll take a look, as you can right here. Okay, so this is what you expect to see. Let me get rid of last week's. This is going to be live, and I should downsize this screen a little. Okay. So this is what you would expect, right? So this is actually, you'll hear people refer to a volatility smile. This is more of a volatility smirk. Smile would be symmetrical. Remember, we were looking at silver, and the upside calls actually traded at a little bit of a premium to the downside puts. Not uncommon in a commodity, but in index land, generally speaking, the downside puts are going to trade at a premium to the upside calls. There's a lot of reasons why this is. One is supply and demand. People like to own protection and they like to sell upside calls to collect a little bit of premium, and that dynamic can help create a little bit of skew. That's a reason. It's not the reason, and it's not the only one of several reasons. There's another. When the market goes into stress, generally speaking, correlation rises. And as correlation rises, then the volatility of an index will also rise, all else equal. And in fact, it will generally not be equal, because when the market declines, typically the volatility of all assets goes up and the correlation goes up. So you put those two together, so the downside puts in an index should trade at a material premium. And they do. However, that does create an interesting opportunity for the long-only players who are using options to hedge their positions, because it can mean that the downside puts trade at a fairly substantially higher implied volatility, and you get a more attractive risk reward on spreads. So just on an absolute basis, and let's demonstrate that, okay? So we're going to just go out, we'll go out 30 days just to illustrate this. And I'm going to compare two things, okay? We're going to compare a 30-day call spread to a 30-day put spread. And where did it close? 575. So we'll get, we'll look at the 574, which is the at the money puts, and then we'll sell another one. So those are about 930. And I will sell another put against that. Let's see. Why don't we pick, because we want to pick something where the math is conveniently easy. How about this? A $20 spread, right? So there you go. There's a $20 at the money put spread that expires in approximately 1 month. That $20 spread costs you just over $5 at the midpoint. So 25% of the distance between the strikes. Now, I'm making sure I have the same expiration. We'll do the same exercise now the other way. Oops, there we go. So now I'm looking at a 574, 594 call spread. And this now costs so this is a $20 at the money put spread. Costs you $5.36. And here's a $20 at the money call spread. Costs you $9. Okay. Now, this is something Dennis touched on before. The carry cost thing that I was talking about with silver, so how the futures should always trade under normal circumstances at a premium to spot because they're going to account for things like the cost of capital, storage, and insurance. Well, there's a little bit of that here too. So the forward is generally going to be higher because there's an opportunity cost to deploying capital into the markets. But part of the function that you're seeing here is related to the skewness issue. And that, by the way, is also the reason why you get that asymmetry when you buy call spreads in something like IBIT. So that skewness, you're getting a higher implied volatility for that put that you're selling that's out of the money. In this case, the 554 is $20 down. Than you are for the $20 out of the money call that you're selling. In this case, the 594s. Consequently, the risk-reward relationship for the put spread is about 3-to-1. And the risk-reward relationship for the call spread is, 11-to-9. So 1.2-to-1. That's a big difference. So that's one of those dynamics. And this is also one of the reasons why you get that asymmetry in IBIT, which is the Bitcoin ETF, because Bitcoin, much like commodities, has positive call skew. So you're going to sell a much higher implied volatility on that upside than the one you're buying at the money. And one further point, this is, a little inside-y baseball kind of thing. But you expect instruments within a complex to exhibit options prices that relate to one another. First of all, what do I mean by a complex? What I mean by a complex is you can buy or sell Bitcoin or Satoshi or any other, related instrument like the ETF. You could buy the Grayscale Bitcoin ETF, or you could buy IBIT, which is a Bitcoin ETF. And those things should behave relatively similarly. If they didn't, there'd be an arbitrage opportunity. For example, if IBIT exhibited significantly higher volatility than Bitcoin, then presumably you could trade one against the other. You could buy Bitcoin and then short IBIT when it got out of whack to the upside and, do the opposite trade the other way. The same thing is going to be true in the option space. So all of these instruments are going to be somewhat related to one another because an arbitrageur who is, able to do the math is going to figure out whether everything's appropriately priced. Why does this matter? So we previously talked about how when MicroStrategy sells converts, for example, they are effectively selling call options on their own stock. It's a bond plus a call. That's what a convert is, right? So if they start selling optionality in big quantities, up a certain amount, and MicroStrategy's price is functionally related to the price of Bitcoin, which it is because that's the bulk of their business now. Their software business isn't really anything, so it's the book value of Bitcoin. Well, what that means is you have a big premium seller in Bitcoin effectively up, in the case of the conversion prices for MicroStrategy, up about 50%. And you could see, we're not seeing it yet, but you could see, and it's something worth paying attention to, you could see that upside calls and things like Bitcoin would start to get slightly depressed if there was a sufficient amount of issuance in a related instrument. Now, in MicroStrategy's case, because there's a little bit of leverage on that balance sheet, it's already trading at about twice the book value of the underlying Bitcoin assets. Like I said, you'd have to do a little bit of work to figure out where that is, but it's worth paying attention to. But it's one of the reasons why call spreads and IBIT on a risk-reward basis set up fairly attractively, just like SPY put spreads set up relatively attractively, pay off 3-to-1, and the call spreads don't. And this is, oftentimes for people who are watching, your trading options, some of this carry cost stuff, of course it matters in the sense that all of these things are being incorporated into the price. You should not ignore them. But if you're simply going to allocate money on top of positions you already hold anyway, so if you have a long equity portfolio and you're thinking about hedging it with SPY, and you're not going to sell those stocks anyhow, which usually people won't because there's all kinds of unpleasantness associated with that, not least of which is it could trigger a tax consequence, or at the very least it could change your basis, your holding periods. So a lot of times people will hold underlying positions and then look to trade things around them, and such is the case here. PC says, last Friday, Dennis Davitt discussed VAR versus vanilla. So VAR, I think you're talking about variance swaps. And when it's steep, people are short VAR versus vanilla. Okay. What he was talking about is that I think you are talking at this point about the effectiveness of VIX calls as a hedge versus SPX puts. I think that's what the portion of the conversation you're probably discussing. So, first things first, and I urge you to go to the SIBO website, because if you want to understand more, you can go to SIBO, and they have a white paper on the volatility index calculation methodology. Right? So you can go in here, and essentially what's going on is they are trying the VIX formula, and that's it right here. Blow that up a little. So this is essentially an interpolated value that would be the functional equivalent of a variance swap. So what this is sort of the sum. It's a sum product average here, effectively, of the weighted implied volatilities by strike. Why is that the case? Because if you trade a variance swap, the vega of the variance swap doesn't change based on changes in the spot price of the underlying asset. So if I buy a 1-year variance swap on S&P and I buy 25,000 vega, what does that mean? It means, the vol goes up by 1, I'm going to make $25,000. It goes down by 1, I'm going to lose 25,000. It's not a function of spot. Vega in fixed strike options land is a function of the strike itself. And this makes complete sense, and it will the minute I say this. The vega of a $10 strike option that expires in 1 year on a $10 instrument is going to be smaller, of course, than a $100 strike on a $100 instrument, right? Obviously, one's going to be 10 times bigger. So the way they deal with that in the VIX calculation is they weight them. So the lower strikes have higher weights than the higher strikes do. The idea being that the sensitivity is essentially flat, like a variance swap would be. Now, variance swaps, first of all, most people watching this probably never have traded a variance swap, and you probably never will, since it's an OTC product. It's an institutional product. You'd have to have an ISDA with a bank. And the other thing is, I'm not even sure why you would necessarily, but the thing I would point out that there are lots of things that are attractive about variance swaps, but there are lots of things that are unattractive too. Just the fact that it's an OTC product can be an unattractive aspect, because then you're dependent on your counterparty to make a market for you when you want to unwind it. But the other thing is that a lot of variance swaps have caps in them. So they don't have the unlimited upside that the listed products do. You know, think of it more like a call spread on vol in some instances. And, you know, some of those things have fallen into and out of favor. The point he was making is that the with respect to skew is that you can get into a situation where if there's a lot of skew in those downside puts, I sometimes like to say that the VIX is probably very close to the implied volatility of a 30-day 25 or 30 delta put in the S&P. And so if vol is elevated, that would make it go higher, and if it goes down, it would make it go lower. But if skew tilts up, then also you can have that same dynamic. So his simple point was that the benefit of the SPX put was more pronounced. You have more moving pieces in that VIX calculation that aren't necessarily about what happens to the underlying instrument. There's another example I would like to provide that will maybe help illustrate why, if you want strict delta protection for a portfolio, sometimes it's easier to buy SPX puts, and here it is. In 2008, actually, why am I saying when I can just show? My bad habit. So let me get into this. Let's do it. So let's go back to 2008 and 2009. Okay. So, and actually we're going to back even farther. I'm going to go back to September of 2007, and I'm going to go forward to September of 2009. Okay. And let's just get the price of the S&P in here as well, so we can all remember this. But it's something I remember quite vividly. And let's just throw the VIX in here, because this is going to be helpful for us as well. So I want to show you something. And actually, these other volatilities aren't as important for the moment, so I'm just going to kill these other two things just for now, so we can take a look at this. So hopefully you guys can see this chart. And what you're going to see, you'll remember that the market really freaked out in October. It was the collapse of Lehman Brothers. Okay? So I'm just going to draw a line here. And actually, it doesn't really matter too much where the line is, but I'm going to go, yeah, we'll go here. Okay. And the reason for this line is going to become clear in a second. So Lehman Brothers blows up. The world's coming to an end. Everybody thinks it's going to be financial catastrophe. The second Bush administration, George W. Bush administration, we had Paulson at Treasury. We had the Bernanke at the Fed. And everybody's trying to figure out what they're going to do. Massive liquidity. But here's what happens. So the S&P rolls over in October. You can see it got down over here, 863-ish. And look what happened to the VIX. VIX spiked. It had this massive, massive spike in it. But what's interesting is that if you fast forward to March, March is actually when the market hit its bottom. And I think we call this the Mark Haynes low. So for those who remember, Mark Haynes was really a lovely guy, but he was a long-time anchor on CNBC. I believe he was on the New York Stock Exchange. And it was this day that he said, I think that's it. He just made that pronouncement and just said, I think that marks the lows. Take a look at where the VIX was on that day. Substantially lower. Oops. And then I'm looking at the wrong VIX here. We want this one. Sorry. This will be a little cleaner. So the market hits its lows here, but the VIX is much, much lower than it was here. And the reason is because people had become more acclimated to it. So the point that Dennis was making is that if what you're really interested in protecting against is a move in the underlying asset, buying SPX options is a purer way to play that than making a bet on volatility. Because in this particular case, the S&P hit its lows in March, but the VIX hit its peaks in the tail end of 2008. So in the example he had provided, which was actually around the August timeframe, I believe, of last year. So let's just take a quick peek at that. So that was 24, and then we'll just go through 0930 of 24. So we had that big washout in August. That didn't work. Why didn't it? What did I just screw up here? Didn't like what I did somehow. Why not? I'm doing the dates wrong here. I just put a different date in. Okay. So here we had the big washout in August. Someone's trying to get in touch with me. And this is the period that he was talking about. So you can get a circumstance where you get a big VIX spike and that works, but then you can have other circumstances where the market washes out and you just don't get the bang for the buck. So the message there was keep it simple. And as far as variance is concerned, it's only vaguely important to have some idea of what variance is. I mean, variance and standard deviation are just are very related to one another, right? Well, one's just the square of the other. The convenient aspect with variance is that it's easy to do math on it. You can add it and subtract it, and it's very easy to quote over the counter because it's always spot. So you can have a bilateral agreement, which means I'm going to make a bet with you about the next 3 years variance of the S&P, starting here and now today. Not that easy to construct listed products that do that. You kind of need to layer and package things. The SIBO has tried to. They had VIX futures for a while. I mean, variance futures for a while, and it just never got any traction. Okay, so let's see here. Bought NVIDIA May 90 call at 29 when the stock was 117. Today sold the April 130 short call against it for 232. Well, let's have a peek. Let's see what that looks like. And let everybody else see it at the same time. So, look at that. See, I remembered to put the ticker in first, instead of manipulating the structure and then going back to the ticker and starting all over again. So you have the May 90s. Right. So, okay. Quick. All right. I'm curious why, and you can elaborate on this. Why such a deep in the money call? Because that's basically a proxy for stock at this point. I suppose it's capital efficiency if you don't have CPM. Would be one possible way to do it. I mean, it's not the end of the world. I don't normally advocate, buying short-dated 100 delta options unless you really. Yeah, I'm not 100%. So the long call side, we'll just leave that alone. I'm going to treat that like stock because that's effectively what that is. And long stock plus a cheap, out of the money call, but that's well out of the money. It's 30% below where the stock is trading right now. You sold the 130s against it for April regs. So yeah, we'll just assume it's April regs. Yeah, I mean that's fine. You're collecting well over 1% of the current stock price. That's the first thing I would say, which is a positive. The second thing I would say is that there's probably some resistance. I mean, I don't know if it's going to be at 130 or so, but anybody who is buying the stock, trying to catch it on the way down, it looks like this is probably the level. I don't know if you can really see this. Let me see if I can blow that up a little better. Maybe I can bring up a different chart. But to me, it looks like 134-ish. So you can see right over here, this day. So let me bring this, I'm going to shorten this up so we can get a closer look. Let's go to Let's just look at it year to date. That's probably fine. So over here and over here, right? So these are the levels. So 130. I mean, I guess you're going to be looking at the 150 or something like that. Is that about what we're dealing with? Let's see. So you think resistance at the 150? That's what that looks like that could be. Is that about where that is? Yeah. Ah, that was a pretty good guess, I guess. Could it run into some resistance there? I suppose. I mean, I like the strategy. What do we have for catalyst? Anything that's gonna? So they don't have any important announcements until their May earnings. Yeah, I mean that's fine. That's a fine strategy. I also think, if you're willing to have so much downside, which clearly you are because you've got that deep call, which is going to behave just like stock. I guess my question would be, would it not make more sense to own that longer dated May option, which captures the next big catalyst, which is earnings, and then sell strangles against it near dated? Because your downside risk, you'll still collect some premium. Your downside risk won't be quite as great. That's just, this is what this looks like now. So what would what I'm proposing potentially look like? Yeah, so let's go like this. I'm just going to do this. That was the... If I sold a similar delta put, maybe a little bit less actually, I'd probably go something like this. That's going to look a little bit like that. Okay? So this near downside is going to get a little bit more muted. It's not going to have quite as much. You're going to have, in either case, you're still going to have similar stock-like risk. But around spot, this trade would have slightly less stock-like risk than yours have. Does that make sense? I hope it does. Look, it's a different approach. It's just one that I would consider. Think about it. Channel bottom for okay, yeah. So I was actually, I think when I was looking at this, I was looking at the futures. I think when I started this whole thing. But let's just take a quick peek at. We'll use SLV. These two will behave very similarly. I think I was using the futures. So let's just take a peek here. Yeah, we're about halfway down. I'm going to guess we're probably going to get somewhere on this line. Okay. So down another 3% or so would be, and we can take a look at, and I was looking at the futures. So, the futures, every contract's 5,000 ounces. So the tick value is going to be a little bit higher. Let's see what we got here. The Bollinger Band's a little bit on the lower side of that. That's a function of the higher volatility we're seeing. But yeah, so, I would say 3 to maybe 5%. I don't mind getting long down 3.5% from here. That's probably where I'm expecting that I will dip my toes in. Okay, Elgato, Smokey. Vuori is taking market share from Lulu in that key demo. Well, I know that to be true. I think there was more stuff from Vuori under the Christmas tree this last Christmas at our house than there was stuff from Lulu. First of all, I don't really buy anything from Lulu. I don't buy anything from either place, but it's not bought for me either. But I did get a number of things from Vuori. I think everybody in the household did. And I actually have been to the local Vuori store because I wanted to make sure that my wife had something to unwrap. So I went to the Vuori store, which is just down from the Lulu store at the mall closest to me. And yeah, it clearly, there's a lot of crossover. My take, I don't know what you guys think of this. My take on the Vuori stuff is that in terms of athletic apparel, it seems a lot of the things seem more sort of like sweatpants or whatever. on SLV, am I looking for the oscillator to go green? That was what I was waiting for, not on SLV, but on the futures, yes. They're going to happen around the same time. But I'm just also trying to give you a forecast for where I think that's going to happen. But let me get back to the Vuori thing. Vuori is definitely taking some share. And like I said, we're about to find out. They're going to tell us what's going on Thursday. Some of this is Peter Lynchy anecdotal stuff. You know, wander by, take a look inside, see what it looks like. Ask people who shop there, people like my wife. And then go to alternative data sources like Bloomberg Second Source and Placer. And then just take a look at the global macro trends. I think that some of those global macro trends are maybe not going to affect them quite as much. But to your point, Vuori could be taking some Lulu dollars, which is why I like the 1x2. So there you go. Okay. Broadcom seems to have stalled given the quarterly earnings report that just posted and good guidance. It was anticipated that it would cross 200 easy on a day like today. What happened? Thoughts on 210, 230 June calls in Broadcom? Well, let's take a look. All right. Let's see what we got here. It looks like it's sort of bouncing around on the 150 right here. Thing is trading. Let's take a look at our magic numbers. 28 times. And next year's numbers. Oops. 24 times on a 19% anticipated growth rate. That's pretty positive. That's pretty positive. What's next on the calendar? Nothing until their June earnings. And you were looking at June, I think, right? 210, 230s. Well, let's take a look. I like that. I like the fact that you're going to try to capture earnings. Don't like to see it underperforming. There's that relative strength issue. I mean, if it breaks solidly below the 150, maybe not so much. But let's just look out to June and see what that one looks like. So you're looking at the 210s. I don't know whether you're talking about the 210s or the 230s. I'm assuming you mean a call spread. So that's what I'm going to look at. Which you can, so that's a $20 call spread. You get it for 3-to-1 payoff. Yeah. As a way to speculate to the upside, I prefer that to buying the stock because, like I said, if it breaks through this level, I think there is some downside risk, and it's showing some relative weakness today, which is the other reason. But otherwise, I think the structure you've chosen is a good one and reasonably priced. Going into the print. Okay, so I have chewed up a solid hour of your time. For those of you who stuck around with me, I really appreciate it. If you happen to be watching, so like, subscribe, notification bell, and all that kind of good stuff. And, to the point of those who might be watching recordings, if you have a question, put it into the comment section, and if we can, we'll try to get to it. Sometimes the live chat gets pretty filled up and we don't have time to get to everything, unfortunately. But there may be instances where we get through everything in the live chat and we still have time to answer other questions. So put them in the comment section. You never know. Thank you all for watching. I'll see you on Wednesday.